really, really good that we are talking about financial capability and financial education, but what I want to try and do is actually put this in context just to explain what the challenges are and the size of the challenges facing the UK at the moment if financial capability is to have any real impact on changing behaviours and, more importantly, improving the lives of ordinary consumers. So without further ado, I don't know if you can see that very clearly. It's one of those busy slides that I like. Now, whenever we work on this subject at the Inclusion Centre, whenever we look at financial exclusion and financial underprovision, which is just as important, we tend to sort of have we keep a sort of a roadmap which explains what we're trying to do, what we're trying to achieve for consumers. So we have this sort of thing called the journey to financial resilience and longer term financial security, and it kind of starts off with consumers who are financially vulnerable or financially insecure. And those are the characteristics, people who are in debt, who are in a negative position, who are in arrears in their bills, who don't have access to bank accounts, who don't have insurance and so on. They're sort of starting actually behind the starting line. They're not even at the starting line at the moment. So we do a lot of work on trying to get people up to the starting line, what we call there sort of square one, where you're out of debt, you're sort of back in a neutral position, where you've got a bank account, but you might not be using it that well. So you've paid off the unmanageable, unproductive debt, but at that stage you're still underinsured or underpensioned. Now then the next stage along this sort of journey really is if those interventions work, then we try and get people to sort of a position of financial resilience. Now financial resilience really just means the ability to withstand financial shocks, unexpected, unforeseen financial shocks, and that means that you have a surplus in your income every month if possible. You'll not be in debt every week or every month. You're using the banking system well. You'll have emergency savings of at least 3 months' worth of income, net disposable income. You'll have access to fair and affordable credit. Access to credit is not the issue. It's access to fair and affordable credit is the real problem in this country. You'll have basic insurance cover, some form of safety net, and the beginnings of pension provision. And you're starting to save for pension. But the end of the journey, what we want to get towards is having more and more households in a position of financial security. That means that they do have sufficient means to meet their longer-term financial needs and demands. They have proper insurance cover, not just for contents, but for income replacement as well. They're either paying off their mortgage or they're paid off their mortgage if they have it, if they have a mortgage, which is becoming less relevant for more people actually. They'll have significant pension provision, in terms of asset accumulation. And then when it comes to the famous debt to assets life cycle model, they will be in positive territory by the time they get to middle age. That is the sort of the journey to long-term financial security. Now keep this chart in mind whenever I start going through to actually populate this chart with some numbers. And this is why, as I say, if you're not depressed, you can't see the charts or else you haven't understood what I'm saying because of my really thick, broad Northern Irish accent. Yeah. So, right, so how far back are we starting? Now, according to MAS, and MAS has done some brilliant work on this. There's something like 23% of adults are considered to be struggling at the moment. That means they're struggling to keep up with their bills, and they find it hard to build up a savings buffer. 25% of adults, 1 in 4 adults, are squeezed. They have significant financial commitments and little provision for income shocks. Now, last year, I think MAS did some work, where they reckoned that 71% of households received an unexpected bill of between £200 and £400. Now, thankfully, just over half of the struggling households were able to meet those bills without having to use their savings or cut back. However, 42% of those struggling households either had to cut back in their spending, borrow, or else couldn't pay the unexpected bill. So again, that's an indication of how sort of the low levels of financial resilience or the high levels of financial vulnerability amongst a number of households in the country. Similarly, I'm not sure if this actually was MAS, this might have been the department, this might have been BIS or something, but there's around 8 million households are considered to be over-indebted in the UK as well. That means that's the definition of that is that debt is a heavy burden. People have missed bills or credit commitments in 3 of the last 6 months. Now, interestingly here, this isn't just consumer credit, by the way. This will include things like utility bills and council tax. That's a big, big issue for people in lower to medium incomes. they are probably actually bigger debtors for lower to medium income households than actually credit card companies or even payday lenders. That's the big problem for a lot of people, particularly in lowest incomes. Now, if you remember at the first slide, we talked about a poverty premium that people who are most financially vulnerable pay for being poor. And the Joseph Rowntree Foundation reckons that the poverty premium cost the lowest incomes around £490 a year just for being poor. They pay more for their goods simply because they're poor and they don't have access to the same products and services that middle-income households do as well. Now, one of the positive things over the past 10 years since the financial crisis is that there has been some signs of deleveraging of consumer debt, but that has predominantly been amongst mortgage debt in sort of the better off households who have taken advantage of the very low interest rate environment to repay their debts. There has not been significant deleveraging when it comes to unsecured credit, and that's the really difficult debt for the people that we're worried about. That's now back up to about 200 billion, driven by these new car loan schemes or whatever. And I think the low base rates are actually concealing a lot of problems as well. I think a lot of people think that because rates have been so low for so long, that actually that must have eased the burden for people who have unsecured debt. But of course, we ran some figures there yesterday, just in preparation for the conference. And if you look at the margin between credit card rates and the base rate in the 5 years prior to the crisis, the margin was 10.9% average across that 5 year period before the crisis. Similarly, when it comes to overdrafts, the 5 year average margin before the crisis was 11.6%. The margin in the past year averaged at 19.5%. And indeed, if you look at the FCAs analysis of the credit card market, there's effectively two markets now at the moment. There's a market for whom credit cards are actually working very, very well. Indeed, people are shopping around, they're switching zero balance transfers and all that stuff, But actually, there's another market. There's the high risk, high cost, more or less subprime market, and in that market, people are paying up to 50% interest rate for their credit cards. And if you do the calculation on unauthorized overdrafts, then the APRs on unauthorized overdrafts are actually higher than some of the worst payday lenders everywhere as well. So as I say, the fact that we have this long period of low base rates have now just started to tick up there recently, I think that has concealed and has actually stopped us really debating that actually for a lot of people, the low interest rate environment is kind of an irrelevance. They are still paying well over the odds to get consumer credit and to repay consumer credit as well. You might ask, well, what's it got to do with sort of long-term savings and investment? Well, quite simply, one of the biggest problems, one of the biggest barriers to savings is people having debt. And as I'll come on to explain in a minute, what happened in this country, I believe, this is just a personal view, is that it became too easy to borrow and far too hard to save. And that partly explains why we're in the predicament we are now. Now, one of these days, despite the best efforts of everyone involved in debt advice and financial capability and what have you, we are going to have to face up to the fact that a significant part of this debt might never be repaid. Some of these days we'll have to face that. If you look at the FCA study as well, they reckon that 5.1 million of the credit card accounts at the moment will take 10 years to pay off the debts. That's assuming that they have no further borrowing and assuming current repayment patterns. That's 10 years to repay the outstanding stock of debt. Forget about taking on new debt. That's just to repay the outstanding stock of debt. Okay, so more good news. Looking at turning to sort of, what about, how many people have got this sort of cushion against unforeseen events and what have you. And really the important things to look at here is whether or not people have got savings or do they have some form of insurance, But again, it's been mentioned already, but the savings ratio is actually falling again in this country really, really badly. Fallen really badly, actually, worryingly so. And around half the households have less than £1,500 worth of savings. So therefore, whether or not the Bank of England puts up interest rates or banks put up the rate, the savings rate is actually irrelevant. It's immaterial to most households in this country. If savings rates went up by 1 full percent, the typical household in this country would gain 18p a week from their savings. So it's actually irrelevant. The base rate is actually irrelevant for large numbers of people in this country. Now, this is a really interesting piece of analysis we did looking at the savings ratios, the longer-term savings ratios in the UK. There is a kind of a myth, and it's usually put around by neoliberal economists, that having a sort of a strong welfare state encourages a culture of dependency and actually, undermines self-reliance. Actually, the reverse is true. We went and we looked at the OECD database for the long-term savings ratios, and we grouped the countries into 3 different groups. The kind of the Anglo-Saxon countries, the UK, America, Canada, Australia, whatever. What we call the family-centric countries, they tended to be the Mediterranean countries where the family is the main unit of welfare provision, actually. And then we looked at the continental social model countries, the Scandinavian countries and so on. And what you actually find is that the 10-year averages look like that. It's actually the countries with the strongest welfare states also have the highest savings ratios. And it's the countries with the weakest welfare states have the lowest savings ratios. Now, there are other factors like the role of property and so on, and I'm not saying that relationship is actually rock solid, but it just gives a lie to the belief that a strong welfare state actually discourages self-reliance and undermines dependency. It is just not the case from the evidence. Now, on the insurance side, it looks like, we look at the Financial Inclusion Commission's work, Chris Pond and all the work, the brilliant work that they've been doing. It appears that sort of half of the lower income households don't have home contents insurance compared to just 1 in 5 of households on average incomes as well. Now, not having those contents insurance can be a real problem for people in low incomes who are faced by an unexpected bill. More generally speaking, look at the sort of income and mortgage protection insurance. The latest data looks as if only 1 in 10 households have got that form of insurance to protect themselves against the loss of income or the loss of health or whatever loss of job. And when it comes to pension provision, again, piling on the good news here, there is really, really still, despite the success of auto-enrollment, there are still worrying levels of under-provision in key groups, particularly amongst the self-employed. Currently, 16% of the self-employed are contributing to a personal pension. That's 17% of men. And of course, as ever, it's women who are actually discriminated or disadvantaged the most, again, when it comes to financial exclusion. 12% of self-employed women are currently contributing to a personal pension. A group that I chaired in Brussels, the FSUG, we looked at pension provision across a wide range of European Union states, and the UK pension coverage, compared to the rest of Europe, is really heavily skewed towards the first and second income deciles as well. So we have a really unequal and unevenly distributed pension system as well. Now, the shocking figure, I think, that's just recently come out, I think, is that the net wealth of UK households has tripled since 1995. Tripled. It's been an increase of £7 trillion since 1995. And 3/4 of that, 5 trillion, is actually accounted for by the housing stock. Most of that is not the value of the property, it's the value of the land. Now, that has simply been one of the biggest intergenerational transfers of wealth in living memory. So we have, there's plenty of wealth in this country, but again, the wealth is tremendously skewed towards older generations and towards, obviously, better off households as well. So it's a huge intergenerational transfer of wealth. It means that younger generations are being penalized. Because what's the impact of that, of course? Well, if you look at the work the Resolution Foundation has done, it tells you that in the 1990s, low to medium income households took, on average, 3 years to save for a first-time buyer deposit. That is now 20 years to save for a first-time buyer deposit. And that also has spillover effects into the rental sector, where the proportion of income spent on housing was 10%. That is now 36%. So again, that transfer of wealth to older, better off households hasn't just sort of pulled up the property ladder, the property owning ladder. It has actually pulled up the price of rents for younger generations as well. So that's kind of where we are. As you can see, I don't think I was exaggerating when I said this, where there's millions of households in this country who are a long, long way from getting to financial resilience, never mind getting towards the position of financial security. the reasons for this, the causes of this are complex and manifold, But I mean, we tend to sort of categorize them into sort of three broad categories. Socioeconomic factors, supply side factors, that is the role of the industry, and then demand side factors, the role of the consumer or the household. Now, on the supply side, socioeconomic factors, I'll just run through these really quickly because it's so depressing. We have had appalling performance on wage growth since the crisis. It looks as if average real wages are still 5% below in real terms that they were before the crisis. We have the worst performance in the OECD after Greece. Only Greece is doing worse than us when it comes to average earnings. And looking at 112 countries across the world, the UK comes 103rd out of 112 countries when it comes to real average earnings growth. It is the biggest squeeze in earnings since Napoleonic times. That is the big driving factor in the sort of the wider economy as well. We know that there's been a big growth in 0 hours contracts, temporary work, and self-employment, and that has big implications for the business models of financial services because, as more people move into temporary work, precarious work, it is the business models of financial services have not adapted to the new world of work as well. So that's a big problem, not just for households, but a big problem for financial services. I mentioned housing market changes, but the other big thing to look out for, there isn't just inequality amongst households. There's major inequalities within the regions as well. Now, if you look at the sort of the Bank of England data, this data only comes up to about 2015, I think. But post-crisis, I think only 2 out of the 13 regions in the UK had gross value added, a measure of local economic growth. Was that actually higher than it was pre-crisis? Only 2 out of the 13 regions of the UK. And when it comes to disposable incomes, I think it's only 3 out of the 13 areas where average disposable household incomes are actually higher than they were pre-crisis as well. No sign of significant improvement. If you look at the analysis, it looks as if the earnings squeeze is about to continue. And by 2022, it is expected that average earnings will still be £22 a week lower than they were pre-financial crisis. That's the sort of the reality we are facing when it comes to financial education. I mean, we know that welfare reforms are going to have a big impact on lower to medium income households as well, particularly universal credit. And I don't even want to talk about Brexit, the elephant in the room. If we get this wrong, this will have big impacts on regions. It'll have big impacts on jobs. It'll have big impacts on incomes, and it will have big impacts on prices that people pay as well. So I know I say we can't ignore that, but we haven't time to debate that. On the supply side, on the industry side, I can sum this up really. The sad fact is that for financial services for millions of households in this country are just simply irrelevant. Actually, because the industry cannot serve them on terms that make sense for the industry and that make sense for the consumer as well. I mean, people always say to me, "Well, Mick, changing labour markets, lower returns, lower economic growth, lower returns and equity in the financial markets, and so on. Surely fintech and big data is going to change all that. Surely fintech will change the economics of distribution." The answer we always give is, look, yes, it will improve things for some consumers, but it will be the same consumers who tend to benefit from innovation anyway. The kind of the witch readers or whatever, the money-saving expert clients or whatever, they will gain from wider use of fintech and big data. The people who will not gain from the wider use of fintech and big data will be the financially excluded or the financially underprovided for. Because if there's one golden rule you can learn from financial services over the past 3 decades, is that segmentation is associated with exclusion. The more segmentation there is, the more exclusion there is. Because the greater you can segment households into different profiles, the more you can spot the lower risk, higher profit customers. And the combination of fintech and big data, as sure as night follows day, will allow financial services providers to target with even more granularity those households which are high profit, low risk, and those customers which represent a potential high risk and a potential low profit. So I think that sort of if anything, what we will see the tendency is towards fintech and big data actually exacerbating financial exclusion, not actually improving financial inclusion. And here's a prediction as well. If you want a prediction in terms of sort of the impact on the market, all I can see at the moment is a kind of a culture gap emerging between the people who run financial services firms and the people who are designing fintech products. Now, the people who are on the boards of financial institutions tend to look like me. They're middle-aged white men who are actually just technophobes, you know. But we know about conduct of business rules. We know about regulation. We don't know anything about fintech. But the people who are designing the fintech products tend to be young, ambitious, impatient, and they want to get the products out the door, and they think regulation is a hindrance, and they say regulation inhibits innovation. And one of these days there will be a mis-selling scandal because there's a culture gap between the old people who run organizations and the young people who are designing products. The two sides don't understand each other at the moment, and that's where the big mis-selling scandals will come from in the future. Now, just a quick one on survey. I won't go through this, but look at the appendices. Look at the appendices. There's plenty of data there. But we did a survey recently of 2,000 consumers about what they thought of chief executives and the boards of financial services firms. Look at the back. The findings tell you that the majority of consumers have got little or no confidence that the people who run insurance companies, banks, and investment firms will intend to put their interests first or intend to treat them fairly. And perhaps most worryingly, they have little confidence that the leaders of firms will actually encourage ethical behavior in the firms that they run. So there's still a big issue there with consumer confidence. And the reason why that's important, because if consumers don't have confidence and trust in the industry, they have to be persuaded to buy products. And if they have to be persuaded to buy products, that involves a lot of costs, which then pushes up distribution costs, pushes up unit costs, makes it more expensive for consumers to buy products, and that then contributes to greater financial exclusion. Very quickly now, financial capability. That's what financial capability means there. It is not consumers telling you they feel more confident or they intend to do something. That is not financial capability. Financial capability ultimately is about consumers making better decisions and improving their behaviors. And I have to say, there is some evidence that some financial capability interventions do work on a small scale, but I completely agree with the people who've said it already. The meta-analysis is not very encouraging for financial capability interventions. It is a question of resources. We have limited resources. Where do we want to use the resources to greatest effect? That is the bottom line when it comes to financial capability and financial education. I think of all the things that's going to be a regressive impact on the demand side is pensions freedom and choice. Now, the reason why I say that is because, look, we have made progress with auto enrollment and Nest. We need more. The contribution rates do need to be raised. But I like to think of auto enrollment and Nest as actually filling the pool of retirement savings. That's what it's doing. It's trying to fill the pool of retirement savings. All the freedom and choice does is actually just pulls out the plug and actually allows that pool of savings to drain away. So all the progress we're making, much of that progress we've made through automatic enrollment and Nest is being reversed by the pensions freedom and choice reforms. So what can we do about it very quickly? Lots of stuff we can do on the government can do lots of things here too, but that's outside the scope of this conference. I think the FCA can do an awful lot to help financial inclusion and improve financial capability. The first thing is, they've got to really drive through efficiencies gains in the asset management industry. The asset management industry was making a 37% operating margin. 37% operating margin. That is the second highest after real estate. That is unsustainable. That has got to stop. And if we drive down costs in the asset management industry, then all of a sudden the unit costs be reduced, and that allows more people to come back into the system as well. We need a default accumulation option as well, alongside to to allow people to make better choices in retirement. As I mentioned, on the demand side, look, I think some financial capability apps will make a difference. There will be some benefits here, but I think the biggest thing is really we have got to make greater use of trusted intermediaries like MAS or the single financial guidance body. We've got to make better use of debt advice charities. One of the single biggest improvements we could do is that we could get debt advice charities to actually target people who are about to come to the end of debt repayment plans. Let's say 3 months before they come to an end of a plan. the debt advice charities should target those customers and say, you have been disciplined enough to repay your debts. Why don't you now use that money to open up a savings account? And within about 2 years, they would actually have enough savings to provide a cushion. Relying on demand-side interventions, relying on information provision is not going to work. What can work is the use of trusted intermediaries to actually nudge people into the right type of behaviours. That is the only thing I can see happening.